Somewhere right now, a hedge fund manager in Zurich is having a very good morning. He's not watching the news in fear. He's watching it like a menu. Oil up 18%. Defense stocks up 11%. The dollar spiking. Gold surging. And somewhere in the chaos of what the headlines are calling a crisis, he's quietly making a fortune. This is not a conspiracy. It's not even unusual. War has always made certain people very, very rich, and the 2026 Iran-USA conflict is no different. The question isn't whether money is being made, it is. The question is who's making it, how, and whether any of it makes sense to you. Let's be clear about what's actually happening. In early 2026, military escalation between the United States and Iran crossed a threshold the markets had been quietly pricing in for months. Strikes on Iranian nuclear infrastructure, Iranian retaliation through proxies, the Strait of Hormuz, the narrow waterway that carries roughly 20% of the world's oil supply, suddenly in play. Now here's the thing most people don't understand about financial markets and war. Markets don't react to danger, they react to uncertainty. And the moment uncertainty becomes a known variable, a war, a strike, a blockade, professional money already knows what to do, because they've done it before. In 1990, during Gulf War I, in 2003, during the Iraq invasion, in 2019, when Iran shot down a U.S. drone over the strait. Every single time, the same assets moved in the same direction. The smart money doesn't predict war, it prepares for the pattern. So what does that pattern actually look like? Start with oil. Iran sits on roughly 9% of the world's proven oil reserves. But more importantly, it borders the Strait of Hormuz, and any disruption to that strait, even a threat of disruption, sends crude oil prices into a panic. During the 2019 tanker attacks, Brent crude jumped $5 in a single session. This time, with actual military strikes in play, we've seen larger swings. When oil prices rise, oil companies make more money. It's almost embarrassingly simple. Energy ETFs, funds that hold stakes in companies like ExxonMobil, Shell, they become extremely attractive to investors who see the escalation coming. But oil is just the beginning. Defense is the second wave. Every time the United States deploys military assets, deploys munitions, deploys air defense systems, someone has to restock those. Raytheon makes the Tomahawk missile, Lockheed builds the F-35, Northrop Grumman runs the surveillance architecture. These companies don't just survive a conflict, they thrive. Their order books fill up, their stock prices reflect that. Raytheon's stock rose over 20% in the 6 weeks following the initial Iran escalation in 2020. These are not coincidences, they are contracts. Then there's gold. Gold is what investors call a safe haven. When the world feels dangerous, money flows out of risk and into gold. It happened in 2001, in 2008, in 2020. Gold tends to spike in the early phase of a conflict and then stabilize once the outcome becomes clearer. And finally, and this is the one most people miss, there's the US dollar. Even when the United States is the one starting the fight, global investors still treat the dollar as a safe harbor because the alternative is worse. The euro? European banks have Iranian exposure. Chinese yuan? China has its own calculations. When the world gets scared, money flows to dollar-denominated assets by default. That is a deeply strange logic, but it is the logic that governs trillions of dollars. Here's where it gets interesting. The people who made money on the 2003 Iraq War didn't need to know the outcome. They didn't need to know who would win. They needed to understand two things: which assets move when war happens and how to be positioned before the news breaks. That second part is the uncomfortable one, because the evidence from past conflicts is fairly consistent. Institutional money moves before the official escalation is confirmed. Options activity on defense stocks spikes days before official escalation is confirmed. Oil futures get bid up before the strikes are reported by mainstream news. This isn't necessarily illegal insider information. It's something subtler and arguably more disturbing. It's pattern recognition at scale. When you have access to geopolitical analysts, satellite imagery vendors, signals intelligence consultants, and decades of conflict data, you can see the shape of what's coming before most people can. The retail investor, the person watching the news on television, is almost always the last to know. And by the time they panic buy oil stocks or gold, the professionals are already in for 2 weeks. Now, let me complicate this because it's not all clean. War trades can go wrong, badly wrong. In 1990, when Iraq invaded Kuwait, oil initially spiked and then crashed after the U.S.-led coalition routed Iraqi forces in 100 hours. Anyone who held their oil position through the resolution got burned. The assumption that conflict means sustained high oil prices ignores one variable: resolution speed. A short, decisive military action can actually calm markets faster than they panicked. A longer, grinding conflict is worse for almost everyone, including the economy that started it. And defense stocks? They're already near historical highs in 2026. Buying a $600 stock that's up 40% because war is possible is not a sound investment. It's speculation. The professionals who made money bought those positions in 2024 and 2025 when the geopolitical risk was priced lower. Timing is everything, and timing is the one thing a YouTube video cannot give you. Zoom out for a moment. What this whole dynamic reveals is something larger than a war trade. It reveals a financial system that is extraordinarily well adapted to conflict, not to stop it, not to discourage it, but to absorb it, monetize it, and move on. Every escalation becomes a rotation, out of emerging markets into energy, out of consumer stocks into defense, out of bonds into gold. The machine doesn't judge, it adjusts. And here's the thing that should make you think a little longer than this video will. The countries that produce the weapons, that export the oil, that issue the reserve currency, they face a different set of incentives than the countries where the conflict actually happens. For them, a managed, prolonged tension is economically preferable to either peace or total war. Neither outcome is as profitable as the middle. So the next time you see a war on the news, and there will be a next time, ask yourself a different question. Not who started it, not when will it end, but who already knew this was coming and what did they buy? Because someone always does, and they're already in profit.